All right, let's talk about something every investor faces. That feeling when the market just goes nowhere. It's tough, right? You don't know what to do with your money. Well, today we're going to break down an expert's guide on how to handle the Indian stock market right now. The goal here is to turn all that uncertainty into a really clear plan of action.
So, we're kicking things off with the one question that's probably on your mind, because it's on every investor's mind. Someone asked a market expert this directly, and trust me, their answer is the key to everything else we're going to talk about.
Okay, so to really unpack that big question, we've got a simple roadmap. We're going to cover 5 things. First, we'll get a feel for the market's current mood. Then we'll lay out a 6-month strategy. After that, we'll look at a really powerful lesson from history, see what your next portfolio move should be, and finally, we'll land on the big takeaway from all this.
All right, first up, what's the market's mood right now? Well, according to the expert we're following, the short-term outlook, let's just say it calls for a bit of caution. We're talking about the next 6 months specifically.
And look, this isn't just some vague pessimism. It's a very specific forecast for the next half year. The expert is urging caution, but it's not based on a gut feeling. It's because of several very specific headwinds that are creating a whole lot of uncertainty.
So what are these headwinds? Well, there are 3 big ones. First, you've got global uncertainty. The U.S. economy is slowing down, and their actions can be, well, unpredictable, which affects everyone. Second, geopolitics aren't calming down at all. Tensions in places like Iran, Israel, and Ukraine, Russia are still very much a factor. And third, and this is a big one, is market complacency. The Volatility Index, or VIX, is at a historic low. Think of the VIX as the market's fear gauge. When it's low, it means everyone's pretty relaxed, maybe too relaxed. It makes the market vulnerable to a sudden shock. So you put all that together, the expert's conclusion is that for a little while, the market is likely to be range-bound, with a bias towards the downside.
Okay, so given that cautious outlook, what do you actually do? I mean, if you've got money to invest, what's the game plan for the next 6 months? You can't just dive in head first, so how do you get in?
The main recommendation here is crystal clear. This is absolutely not the time to dump a large lump sum into the market all at once. The risk of a short-term drop is just too high. Instead, the smart play is to stagger your capital. And this approach breaks down into a really simple 3-step plan.
So here's the crucial part. Your long-term discipline, that doesn't change one bit. You keep your regular systematic investment plans, your SIPs, running just like clockwork. But for any new money you want to put in, you get strategic. You use something called a systematic transfer plan, or STP. This lets you move that new money into the market gradually, say every couple of weeks over the next 6 months. Why? Because it averages out your entry price and acts like a shock absorber if the market suddenly drops.
But wait a minute. With all this talk about short-term caution, why should we stay so confident about the long run? Well, the answer lies in history. The expert points to 3 incredibly powerful pieces of data that really give us the perspective we need to stay the course.
Check this out. This is basically the entire story of investing in India in one table. Over the last 32 years, nominal GDP grew at 12% a year. And what happened to corporate earnings? They grew right alongside it at about 12.3%. And the market returns? Even better, coming in at around 14% compounded once you include dividends. The logic here is so simple but so powerful. As the country's economy grows, companies make more money, and their stock prices follow. And this is so important. That amazing 14% long-term return didn't happen during some perfect calm period. Not at all. It happened despite a constant stream of crises. We're talking about major scams, wars, global financial meltdowns, even a pandemic. This isn't a story about smooth sailing, it's a story of unbelievable resilience. The market's ability to bounce back and keep climbing is proven again and again.
Okay, now this next point might honestly change how you view the market forever. Get this. In the years that the Sensex finished up with that average 14% return, it also experienced an average drop of 15% within that same year. Let that sink in. A double-digit dip isn't a sign that something is broken. It's a totally normal, expected part of the journey.
This forces us to completely reframe how we think about market dips. They aren't a bug in the system that we should be scared of. They are a feature. And for the investor who's prepared, what is a feature? It's a recurring opportunity. It's a sale. It's a chance to add to your investments at a discount.
All right, so now that we have that perspective, we know dips are normal, and we know long-term growth is incredibly resilient. How do we actually position our portfolio right now?
For anyone who can't just watch their portfolio drop 30% without, losing sleep, asset allocation is everything. And the expert points out something really interesting about gold. A meaningful allocation, we're not talking 1 or 2%, but something more like 15%, can act as a genuine stabilizer for your portfolio, really smoothing out the ride when things get choppy.
So in a market like this, where there isn't one single hot sector that everyone is piling into, it can feel like there's nowhere to go. But the expert says this is the perfect environment to look for contrarian ideas. Look for those areas where sentiment is really weak, but the underlying businesses are actually rock solid.
And 2 sectors in particular stand out as potential contrarian bets. First is IT. Right now, sentiment is pretty negative, mostly because of its dependency on the US, but the companies themselves are fundamentally strong and diverse. The second is private sector banking, which was a great contra call last year and continues to do well because the fundamentals are just so robust. But here's the most important point. These are not bets on broken companies magically turning around. These are calculated bets on investor sentiment finally catching up to the reality of these healthy businesses.
Okay, so let's tie all of this expert advice together. We've talked about the near-term caution, the long-term historical data, and some specific strategies. So what is the single most important takeaway for you as an investor today?
It really comes down to this. Volatility is not the risk, it's the price of admission. It's what you pay to get those superior long-term returns that stocks offer. And more than that, it's the source of your greatest opportunities. If you can truly change your mindset to see those market swings not as a threat, but as a chance to buy, you've already won half the battle.
And that really brings us to the final thought. The expert is pretty confident that an opportunity to buy on a dip is coming. So the real question isn't if it will come, but this. Will you be ready to see it for what it is, a sale? And that's our explainer for today. By understanding the need for caution in the short term while holding on to that unshakable long-term data, you can build a strategy that turns market anxiety into real investor confidence. Thanks for watching.